There is a tangible force. It's called sentiment. And when people are very bullish, they disregard risk and they keep buying. What makes markets go up? $4 billion a day from retail investors, $4 or $5 billion a day in stock buybacks. We have stock buybacks running at the highest level we've ever had on record right now. So that sentiment is a real force for the markets because the sentiment is what acquires the capital to drive asset prices higher. But when you talk about valuations is a good example. Valuations in the short term, over the course of a year or 2 or 3, is all about sentiment. I'm willing to pay more for stocks today because I believe ABC about earnings growth, and that's fine. So sentiment drives valuations in the short term. Now, when you start talking about long-term valuations, talk about CAPE valuations, those type of things, that has everything to do with forward earnings because you're taking 10 years worth of earnings data and smoothing it by using an average. But in the short term, it's all about sentiment. This year, next year. I'm willing to overpay for stocks today because I think earnings are going to grow more next year, and that's going to justify the valuation I'm paying today. That's my sentiment. So I'm willing to buy stuff, which drives up prices and valuations. So this is a chart of Q3 earnings estimates from S&P. That big crash that you see in earnings estimates, this was the day that Trump comes out, he holds up the big sign and he says, here's all the tariffs that we're going to impose on these companies. And then the next day, S&P goes to earnings. And then that bottom is April the 7th, where Trump comes out and says, oh, never mind, we're just going to do 10% tariffs on everybody and we're going to work these deals out over time. And S&P goes, oh, okay, here's where we think earnings are now. If you take out that big spike lower, it kind of skews the chart to a large degree. Earnings estimates have been coming down for this quarter for quite some time. We started out expecting $243 a share for the S&P 500. We're now down to $232. So we've clipped off $11 of earnings, even though the market price keeps going up. So this is why valuations keep rising so sharply. We keep cutting the E as the price keeps going up. This next chart is the logarithmic scale of earnings going back to 1900. Now, here's what's important about this chart. We're currently above the long-term trend. The middle dash line, that orange line, that's the long-term earnings growth trend for the market. Earnings both expand and contract over time because of recessions, economic slowdowns. Earnings kind of travel within this channel over time, which corresponds with economic growth. Right now, earnings estimates are so far deviated above that long-term exponential growth trend. In fact, it's the largest deviation from the long-term exponential growth trend ever on record. Now, forward expectations into next year are $278 a share. That is above the top of the long-term trend channel of earnings. Analysts are so optimistic. Everybody looks at these and say, oh, well, if earnings can grow at 20% a year, I can overpay for earnings. And so that's what's happening. And as long as earnings continue to grow, investors can be somewhat justified in their purchases.
Catch me daily on The Real Investment Show. The link is in the description.